Unlocking Social Security Benefits. What you need to know. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. Here's something that keeps financial advisors up at night. The average American leaves approximately $111,000 in Social Security benefits on the table over their lifetime, simply because they claimed at the wrong time. That's not a typo. 6 figures of retirement income, gone, because of a single decision made without understanding the full picture. If you're approaching retirement or already receiving benefits, what I'm about to share could be the difference between a comfortable retirement and one where you're constantly worried about running out of money. Let me ask you something. You've spent decades contributing to Social Security through payroll taxes. You've watched that money disappear from every paycheck, year after year. But do you actually know how to maximize what you get back? Because here's the uncomfortable truth. Social Security isn't designed to be simple. The claiming strategies, the tax implications, how it interacts with your retirement accounts, it's all deliberately complex. And that complexity costs people real money. I've seen successful business owners who built million-dollar companies make catastrophic Social Security mistakes. I've watched investors who perfectly timed their 401k contributions completely botch their claiming strategy. Intelligence and financial literacy don't protect you here. Knowledge of the system does. Why does this matter right now? Because the rules around Social Security benefits have been tightening. Some of the most lucrative strategies that existed just a few years ago have been eliminated. Meanwhile, with longer life expectancies and ongoing discussions around the Social Security Trust Fund's solvency, the decisions you make today carry more weight than ever before. Let's talk about what's at stake. Social Security isn't just supplemental retirement income for most Americans, it's foundational. For nearly half of retirees, it represents at least 50% of their total retirement income. This isn't play money we're discussing. This is the bedrock of your retirement security and your ability to maintain your standard of living for potentially 3 decades after you stop working. And here's where it gets really interesting from a tax optimization standpoint. Up to 85% of your Social Security benefits could be subject to income tax depending on your other income sources. That means if you're not coordinating your Social Security claiming strategy with your IRA withdrawals, your Roth IRA conversions, your required minimum distributions, and your overall tax bracket management, you're essentially volunteering to pay more taxes than necessary. You're giving away money that could be compounding in your investment portfolio or funding your retirement lifestyle. The stakes are even higher if you're married. Spousal benefits, survivor benefits, the interaction between 2 earners' benefit histories. These create both opportunities and pitfalls. Make the right moves, and you could add hundreds of thousands to your combined lifetime benefits. So let's break down exactly what you need to know. I'm going to walk you through 4 critical principles that will completely change how you think about this decision. Principle 1. Understanding full retirement age and the power of delay. Your full retirement age isn't 65 for most people. That's a dangerous misconception. If you were born in 1960 or later, your full retirement age is 67. This matters because it's the baseline for everything else. Here's where the real wealth building opportunity exists. Let's say your full retirement age benefit would be $2,500 per month. If you claim at 62, you're accepting approximately a 30% permanent reduction. That $2,500 becomes $1,750. That's $750 less every single month for the rest of your life. Over a 25-year retirement, that's $225,000 in lost benefits. But here's the part most people don't understand. Every year you delay claiming beyond your full retirement age, up until age 70, your benefit increases by 8% annually. That's guaranteed. Show me another investment that guarantees you 8% annual returns with zero market risk. Using our $2,500 example, if you delay until 70, your monthly benefit jumps to approximately $3,100. That's an extra $600 every month. Now, I know what you're thinking, but what if I die early? Social Security has built-in longevity insurance. If you live into your 80s and beyond, which is increasingly likely with modern healthcare, delaying your claim produces substantially more lifetime income. The break-even point is typically around age 78 to 81. After that, every month you live means you made the profitable decision by waiting. Principle 2. The tax torpedo and retirement account coordination. This is where sophisticated retirement planning separates those who thrive from those who just survive. Your Social Security benefits exist in a complex tax ecosystem with your other retirement income. And if you don't understand how they interact, you're going to pay far more in taxes than necessary. Here's how it works. The Social Security Administration uses combined income to determine how much of your benefit is taxable. That's your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. If you're single and your combined income exceeds $34,000, up to 85% becomes taxable. For married couples filing jointly, that threshold is $44,000. These aren't high thresholds. If you have any meaningful retirement account withdrawals, pension income, or investment income, you're likely crossing them. And here's the insidious part. As your income rises between the thresholds, you can experience effective marginal tax rates above 40%. This happens because not only is your additional income taxed, but it also triggers more of your Social Security to become taxable. Financial planners call this the tax torpedo. So how do you navigate this? Strategic Roth IRA conversions before you claim Social Security. If you retire at 62 but delay Social Security until 70, you have an 8-year window where your income might be relatively low. This is prime time to convert traditional IRA money to Roth IRA money, paying tax now at potentially lower rates, and setting yourself up for tax-free qualified withdrawals later. Think about the long game. Once you hit 73, required minimum distributions from your traditional retirement accounts begin. If you haven't done Roth conversions earlier, you now have RMDs you must take, Social Security benefits likely being taxed, and potentially other income sources all stacking up. You could easily find yourself in the 24% or 32% federal tax bracket when better planning could have kept you at 12% or 22%. And don't forget Medicare premiums. Your Medicare Part B and Part D premiums are income-based through income-related monthly adjustment amounts, or IRMA. Cross certain income thresholds, and your premiums increase substantially, hundreds of dollars per month in additional healthcare costs. Strategic timing of retirement account withdrawals and Social Security claiming can help you stay below these IRMA cliffs. Principle 3. Spousal and survivor benefits, the hidden gold mine. If you're married, your Social Security calculus becomes significantly more complex, but also more valuable. Understanding spousal and survivor benefits could add 6 figures to your household's lifetime benefits. Here's the framework. A spouse can claim a benefit based on their own work record or up to 50% of their spouse's full retirement age benefit, whichever is higher. But survivor benefits work differently and often more generously. When one spouse dies, the surviving spouse receives the higher of the two benefit amounts. Let me give you real numbers. Let's say you're a married couple. The higher earner would receive $3,200 per month at age 70, while the lower earner would receive $1,800 per month at full retirement age. If the higher earner dies first, the lower earning spouse doesn't receive both benefits. They receive the higher amount, which is $3,200. That means the couple's combined income drops from $5,000 monthly to $3,200 monthly, a 36% reduction. Here's the strategic opportunity. If the higher earner delays until 70 to maximize their benefit to $3,200, while the lower earner claims earlier to get money flowing, you're optimizing for multiple scenarios. You have income now from the lower benefit. You're maximizing the survivor benefit for whichever spouse lives longer, and you're getting those guaranteed 8% annual increases on the higher earner's record. For divorced individuals, you can claim spousal benefits on an ex-spouse record if the marriage lasted at least 10 years. You're currently unmarried, and you're at least 62 years old. And here's the beautiful part. Claiming a spousal benefit on an ex's record doesn't reduce their benefit at all. They never even know you're doing it. Principle 4. Strategic action steps. Now let's get practical. First, obtain your Social Security statement online through the Social Security Administration's website by creating a My Social Security account. This shows your earnings history and estimated benefits at different claiming ages. Review it carefully. Errors in your earnings history directly reduce your benefits. Second, run the numbers for your specific situation. Use the Social Security Administration's online calculators or retirement planning software. Model different claiming ages for yourself and your spouse if married. Factor in your other income sources: pension, retirement account withdrawals, rental income, part-time work. Calculate the combined income thresholds and see how much of your benefit would be taxable under different scenarios. Third, integrate this with your overall retirement plan. How does your claiming age affect your need to withdraw from retirement accounts? If you delay Social Security, where's that income coming from in the meantime? Your portfolio allocation, your withdrawal strategy, your Roth conversion plan, your estate planning goals, they all interconnect with this decision. Fourth, consider your health and family longevity. This isn't purely mathematical. If you have serious health conditions or significant family history of early mortality, claiming earlier might be appropriate. But be honest with yourself. The statistics show that if you're healthy enough to reach 65, you have a substantial probability of living into your mid-80s or beyond. For married couples, model the survivor scenario explicitly. Run projections that show what happens when one spouse passes away at various ages. Which claiming strategy leaves the surviving spouse in the best financial position? This is often the factor that tips the scales toward having the higher earner delay until 70. Let's bring this all together. Social Security benefits represent one of the most valuable assets in your retirement portfolio, yet most people spend more time planning their vacation than planning their claiming strategy. The difference between an optimized approach and a default approach can easily exceed $100,000 in lifetime benefits, and the tax implications can add tens of thousands more to that number. Understanding your full retirement age and leveraging delayed claiming, coordinating with your retirement account withdrawal strategy to minimize taxes, maximizing spousal and survivor benefits, and integrating everything into your comprehensive retirement plan. These 4 principles form the foundation of Social Security optimization. Remember that this decision doesn't exist in isolation. It's interwoven with your 401k and IRA withdrawal strategy, your Roth conversion opportunities, your Medicare premium planning, your required minimum distributions after 73, and your overall retirement income tax management. The most successful retirees aren't necessarily those with the biggest portfolios. They're the ones who extracted maximum value from every income source while minimizing the tax drag on their wealth. If you found this breakdown valuable, hit that subscribe button so you don't miss the comprehensive content we're regularly publishing on retirement planning, tax optimization, and wealth management strategies. Drop a comment below. I want to know what your biggest Social Security question is, or share which principle from this video changed how you're thinking about your claiming strategy. And if this information is worth something to you, click that thumbs up button as a thank you for diving deep into these critical financial topics. Before we wrap up, I need to be crystal clear about something. I am not your financial advisor. The information shared in this video is educational and should not be construed as personalized financial advice. Your situation is unique. Your health, your income sources, your family situation, your goals, your risk tolerance, your tax bracket. Before making any decisions about Social Security claiming, retirement account withdrawals, or tax strategies, consult with a qualified financial advisor, tax professional, and if appropriate, an estate planning attorney who can evaluate your complete financial picture and provide advice tailored specifically to you. Social Security is too important to leave to chance. Do the work now, make informed decisions, and set yourself up for a retirement where you're not wondering what if, but instead enjoying the security that comes from knowing you maximized every dollar you were entitled to.